Yes, and thank you, Tyler. I'd like to welcome Jerome Schneider, Managing Director of PIMCO and head of their short-term portfolio management. Jerome, we haven't talked in person since COVID hit. It's great that you're here in Chicago, and while you are, I notice VIX right now trading around 2610. And the reason I bring that up is, if you look at the low and high for the year, that's almost exactly at the midpoint, and I know that one of the themes we're going to discuss is the liquidity issue and the volatility issues that are affecting equities and interest rates. And that really shows me that maybe investors are getting used to it, but they're not definitely looking forward to more of it.
Right, and you can actually look at it and extrapolate it to fixed income, which is what we're most familiar with at PIMCO, and rationalize that even when you look at front-end rates, you've seen a tremendous amount of volatility and return round trips, even in the past month. The two-year note has gone from 3.1% to 2.8%, back to about 3.1% today. So the volatility that we're seeing in the marketplace is really punctuated by a known in the marketplace, the single known, which is the Federal Reserve is ever more data dependent than they ever have been in recent memory. And that's creating a little bit of uncertainty, but more formidably is changing liquidity conditions for all investors across all asset classes, equities, currencies, fixed income, hard assets. So as we think about where rates are going, we really should rationalize it in terms of thinking about what are those macroeconomic sensitivities, and then ultimately understanding that the Federal Reserve's destination may not necessarily be as important here, especially if we need to keep an eye on where volatility has come from, is going to, and maybe will revert to. Instead, investors really should rationalize a little bit where we've come from. Front-end rates are no longer in the shape of a donut. What we actually see is that rates have moved higher. It's also increased the cost of capital. Those transactional costs.
As I look at yield curves, but we're inverted, obviously, as Tyler pointed out, around 307 in a 2-year, and 10 years are trying to get over 3%. So we have juicier yields in the front. That's always a positive, and you've always accentuated that. Now, you talk about a data-dependent Fed. First of all, I know they are, but have they ever ignored the data? No. I guess my issue here is their track record isn't excellent. They definitely did not see inflation, even though they had big seeds to make it grow. Shouldn't investors be a little bit concerned that they seem out of phase, past and present to some extent? And QT has barely been active for what, since June?
So I think your point about, the Fed has been actually dealt a pretty difficult set of cards, a hand of cards at this point in time. And it's all about sequencing. The data dependency is something that they've really relied upon in terms of communication and in recent memory. Now that data dependency is slightly working against them in terms of how the market is digesting this information. Last week's economic data, specifically the jobs, is going to pivot to really what they're focusing on this week, the inflationary data.
And that, you know what, that's where we want to be. So it's jobs. Pretty good report, 372,000, not bad, 3.6 on the unemployment rate. But now how do you take that, which nothing in that report smelled of a recession? Now we look to CPI on Wednesday. PPI is not as important to the marketplace. You're looking for 1.2 on month over month. Everybody else most likely is going to be looking at year over year. Give me what happens if inflation on CPI is higher or lower than expected. Give me your two views.
This is the point, is that it's going to emanate volatility no matter what. There's a split decision in the marketplace right now. That split decision you're clearly seeing in interest rate risk, volatility, and equities throughout the market system. What we have to also rationalize is that illiquidity premium has gone higher because we don't necessarily know where that destination is going to be.
And you got to get paid for taking that additional risk.
And that's exactly the point. Higher cash holdings are necessary. Higher liquidity, thinking about active liquidity management is necessary. And in doing so, you're going to be able to absorb a lot of the risk premium if you're going to have a higher cash standard. So the structure is fundamentally changing.